In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, antisocial, President Trump's campaign against what he's calling unfair search and social media. How will this latest spat impact tech regulation? Plus, Elon Musk returns to Twitter, yet again fanning the flames. Why the Tesla CEO can't quit social media despite warnings from investors. And Slack CEO Stuart Butterfield talks to us about building the massive startup and a timeline for a possible IPO. But first, to our top story, President Trump has issued a warning to social media companies after he accused Google of rigging search results to show negative news about him.
Google and Twitter and Facebook, they're really treading on very, very troubled territory, and they have to be careful. It's not fair to large portions of the population.
Experts say it's unclear what he or Congress could do to influence how internet companies distribute online news. Trump has talked about expanding libel laws, but is it possible? For more, we're joined by Matt Schettenhelm of Bloomberg Intelligence. So, Matt, is that possible?
Well, it's possible. Congress has the power to impose pretty serious regulations on internet companies if it would like to. What isn't possible right now is President Trump, I think, taking unilateral action to go after the companies themselves. Any serious action is going to take action from Congress. It's going to be controversial. It would likely lead to litigation as well under the First Amendment.
How much damage could Trump do by continuing to say these things? His campaign texted messages to supporters reiterating that the fake news cycle is in full swing. They're going to continue to beat this drum.
They are, and perhaps it helps the president politically. I think for the internet companies, the real threat is that for 20 years, Congress has taken a very hands-off approach to these companies, believing that the best approach is for the government to stay out of the way. And what we've seen in recent months is really an erosion of that. And now the idea of regulation, serious regulation, is really on the table. That's different from saying that we're actually likely to get there, that this Congress will get there, but we're going to see a number of legislative proposals in the months ahead to regulate these companies in ways we haven't seen before.
So what kind of ways that we haven't seen before? I mean, we're seeing Facebook COO Sheryl Sandberg, Twitter CEO Jack Dorsey preparing to testify before Congress next week. I mean, Mark Zuckerberg going earlier this year was completely unprecedented. What direction could Congress take?
So you're going to see a number of things on the table. Some will be aimed at election interference, and you've seen already the introduction of what's known as the Honest Ads Act, requiring transparency in advertising in social media. You're likely to see more legislation introduced about privacy protections, of really requiring the consent of subscribers before social media can use your information, your data, giving you more control over it, not the company the ability to profit from it. And the more extreme case, perhaps, is what Donald Trump was referring to yesterday, really treating social media companies as common carriers, as utilities, something that his old advisor Steve Bannon had pushed, and really requiring equal treatment, non-discrimination from these companies. That would be very aggressive, and ironically, it conflicts with the First Amendment views of some of the judges that President Trump is appointing to the court. I think some of those more extreme measures would have a real tough time getting through.
What's the most likely scenario then?
To me, I think you're going to hear a lot of noise about this in the coming months. I don't believe the most disruptive sort of scenarios that really disrupt these companies' business models are likely. I think the most likely scenario is probably a regime focused on transparency. We know very little about how these companies' algorithms work. And I think Congress, the most likely scenario to gain a consensus is focused on shining more light on that process. Tell us how you operate. Let researchers see that, and let's go from there.
All right, Matt Schettenbaum, Bloomberg Intelligence. Of course, we've got so much to cover in the week ahead. Thank you so much for joining us. Meantime, Google Maps didn't wait to see if lawmakers renamed a Senate office building for Senator John McCain. The Russell Senate office building across from the Capitol came up on the search engine's map as McCain Senate Office Building for several hours on Wednesday morning. Senate Minority Leader Chuck Schumer of New York proposed the idea of renaming the Russell Senate Office Building for McCain in a statement that was released shortly after the senator's death. Google said in the early afternoon that it was fixing this matter. Coming up, Tesla CEO Elon Musk is reviving old feuds and issuing denials about reports on, where else but Twitter, why Musk's use of social media could get him in hot water again. That's next. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Elon Musk returning to Twitter just days after abandoning his short-lived plan to take Tesla private. But this time his tweets have nothing to do with the company. In a series of posts yesterday, he denied that he cried during a New York Times interview earlier this month and traded bars with a follower who criticized him for calling a cave explorer in Thailand a pedophile last month. Bloomberg's Matt Robinson has been covering this story. He joins us now with the very latest. So, Matt, given that the SEC has opened inquiries into Tesla, namely Musk's communication and how he reveals information, is this risky?
Yeah, I don't think this calms investors or, folks involved in the company. Obviously, these aren't the types of tweets or the types of public statements you're normally accustomed to getting from chief executives about, if someone broke down in an interview or not. Again, these aren't violations of securities laws. Obviously, nothing was mentioned in that regard. But, following the, basically the closure or the idea of taking the company private, that ending a few days ago, that doesn't mean the SEC, stops looking at that statement. Even though they're not going to go forward with that plan, or at least that's, the current state of play, the agency is going to look at the kinds of statements, the factual basis, all of that. So in terms of his latest tweets, I don't think it would probably give a lot of investors, wouldn't calm them that, they'll probably expect some more impulsive statements in the future as well.
Now, the SEC is denying that they are investigating Tesla. What do we know? Well,
the SEC never confirms or denies any probe. That's kind of their standard language. I mean, we've reported that they were looking at this tweet, and we've also reported that the agency was looking at Model 3 production numbers even before this talk of taking the company private. So the SEC doesn't confirm or deny. I mean, that's their standard language. But as we've reported and others, that there is an ongoing investigation going.
But what do we know about the likelihood? I mean, we've had former SEC lawyers on the show who've said, given that they are clearly sending subpoenas out, that means there's an open investigation or signals an open investigation.
Right. So when you send out a subpoena, that's a formal request for information, that says, hey, we want all the communications from, Elon, the board, what was discussed and when. So another thing to point out is that these investigations take years. I mean, the average investigation takes about 2 years. We've written about how the agency is probably going to want to move faster than that here because this is, given with the tweet, it's a pretty finite amount of time. There's a pretty definite amount of evidence to gather. So they should be able to turn around, make a determination if securities laws were violated on that tweet relatively quickly, more quickly than other investigations that they do.
All right, Bloomberg's Matt Robinson, I know you'll keep us posted as we continue to cover this story. Meantime, that tweet from Musk denying that he cried in the New York Times interview was prompted by a contributor piece in Forbes about the stresses of the CEO job and expectations faced by men versus women. Amy Nelson, founder and CEO of the co-working space The Riveter, wrote in that piece, "I read Musk's interview with a bit of wonder, though. I don't believe I could cry in an interview or any public setting." Amy Nelson joins us now from Seattle. So, Amy, first of all, what do you make of Elon Musk's response to your piece, which appears to be his first public response to this New York Times interview, which said that he alternated between laughter and tears?
Hi, Emily. It was an interesting response. I mean, I think, Mr. Musk remained quiet for a week, and he had a lot of options here. He could have said nothing at all, but instead he chose to deny crying. And I think it's really interesting and kind of speaks to the piece itself and talking about how women and men are treated differently in the workplace. And I think we view ourselves differently, too. We've read so many articles about Elon Musk yelling at employees, at journalists, and he's never denied those. But here he stood up and he said, "I deny crying." So what does that mean?
Do you think if Marissa Mayer cried in an interview with the New York Times that investors or analysts would have any sympathy for her?
No, I don't. I think they would see her as weak. I think still in society, we look at women and men with just completely different lenses. Women have to really walk this line in the workplace of being strong but not too strong, of being kind but not gentle, and I really think there's no place for crying.
Now, you've gone on to respond to Musk's response, saying he could have addressed the double standard between men and women CEOs, but instead he simply denied it. Do you think that's, part of the broader problem?
I do. I think that, in the past year in the Me Too movement and everything that's happened, we have started a conversation about how we look at women in the workplace and in America more broadly. But have we made progress? What's the next step? And I think at The Riveter, what we're doing is building this community for women to move forward, and we include men in that. I think that we're at an inflection point where men really need to stand up and be a part of the conversation, and I think it would have been amazing to say yes. If Elon had said, yes, I had this authentic moment in my conversation with David Gellis at the New York Times, and that's okay, and that's good, because we need to show up as our authentic selves as CEOs, because startup life is so hard. And so I think we need men to jump in and say, yeah, it's okay to show that emotion.
The Riveter is a co-working space that is more catered towards women. It's sort of an alternative to WeWork, so you have a lot of female founders, female startup workers in your workspace. Have you seen much progress in the Me Too movement, or is it more talk than action?
I think we're really at an inflection point. If you look at the percentage of VC funding that went to women in 2016 versus 2017, there wasn't much of a change. But I do think that we have seen some movement this quarter. But again, I think we're at this really important point where we need men to get involved. Men still meter the oxygen in so many ways. They are 90% of VC investors. And so we need them to jump in and say, how can I be an ally? How can I work with women to make this change happen?
That said, we're continuing to see companies, you point out the scooter companies that are valued at $1 billion+, and, it's almost unheard of for a company founded by a woman to get top dollar. The skeptics would say that women aren't founding companies with big visions, huge earnings potential. What's your response to that?
Well, I think you should take a look at The Riveter. We're opening our 5th location in 16 months, which means we're outpacing WeWork's early years. I think that to say it's a pipeline problem or to say that women aren't ambitious and can't build billion-dollar companies is 100% wrong. And I think there's so much opportunity, and I think that investors who get on the right side of that will win.
Knowing that Tesla needs to build a diverse workplace, SpaceX as well, what is your advice to Elon Musk as, he has the SEC on his back for simply the way that he has communicated all of this information?
Yeah, I think Elon Musk is a visionary. He wants to change the world, and Tesla can do incredible things. And I think that Elon is taking a good step in showing up as his authentic self, and I think he should own it. As a former litigator, the lawyer in me has to say that perhaps you shouldn't share everything via Twitter.
All right, Amy Nelson, founder and CEO of The Riveter. Amy, thank you so much for stopping by. Coming up, Slack CEO Stuart Butterfield speaks about the competition, workplace diversity, and his thoughts on a possible IPO. That's next. This is Bloomberg. Hewlett-Packard Enterprise came out with a better than expected profit forecast. That's seen as a signal that HPE is starting to benefit from cost cuts and a move into higher margin businesses like networking and services. The company also named Tarek Robbiati as CFO. Well, in the latest edition of Bloomberg Studio 1.0, we caught up with Stuart Butterfield, the CEO of the popular messaging app Slack. We covered a lot of ground, including taking the company valued at $7 billion public and the rising competition from Microsoft. Take a listen.
No, it hasn't really shown up in like actual usage at customers yet. Where it does show up is in the sales process. And I think what'll be really interesting is, people talk about new Microsoft versus old Microsoft. Where I think that will make a big difference is what the policies are for customers. Enterprise software is an enormous category. Microsoft is the single biggest company in that category, but it's still probably only 5% of all revenue. So there's another 95%. And the reality is customers make their choices. They will use one product from one company for one part of their business and another for another. And the degree to which they can interoperate or integrate with one another is really important for the amount of value you can create. So first of all, it's good validation for us. Second of all, we're way ahead on the product side.
So you're not worried about it?
No.
Okay. So you said you're running the company to get ready to go public, but you're not necessarily going public. Where are you now in that?
Kind of in the same position. I mean, I think it's difficult to contemplate, or there's not many outcomes where we don't end up going public. I don't have any kind of timeline. We're not in a rush to achieve that. It is an unusual circumstance because I think in any other 10 years ago, 20 years ago, we would have been public long before we got to this stage. We're a big company with hundreds of millions in revenue, and we're still private.
Would you consider selling? I mean, we've chased speculation that there's a buyer out there for Slack at an insane valuation.
There's definitely people who would be willing to buy it. So, first of all those stories are wrong. It doesn't work that way with private companies. So it's a much more circumspect kind of conversation. Hey, Stuart, if you would be interested in talking about how our companies could work more closely together, we would also be interested in having that conversation, or something like that. And if we don't respond positively to that, if we don't say, yeah, that sounds great, let's talk about it, there's no offer. No one ever just says, here's a check, want me to sign it? We're so optimistic about the future and having so much fun, and I personally would like to do this for another 20 or 30 years if I can. It doesn't make sense to sell it. And I feel like when I say unbounded potential, I mean, we should end up as big as Microsoft if we're able to execute in the way that I hope we can.
That said, Microsoft, Facebook, and perhaps even Google are trying to do what you do. Do you think they have too much power?
I mean, if I just have to answer that question point blank, I think I would probably say no, but it really depends on what you mean by too much power. I do think that those things change. Sometimes they seem impossible. People really tend to overestimate the short-term effects of technological change, but they underestimate the long-term effects. And I think the same thing is true in business. Stuff just compounds. So there will be disruptors to those companies in the fullness of time.
I know you are nervous about being held up as a model for diversity, but the truth is your numbers are far above industry average when it comes to diversity. And you personally decided very on in Slack's life cycle to make it a priority. What was the spark that sort of brought you that realization?
First of all, it wasn't just me. It was like a company level decision, and it was when we were around 30 people, and we looked around and we're like, this is looking more or less like every other tech company. It just caused a lot of conversation about what is it that we can actually do to make a difference. But the real impact, I think, was more likely to come in building an inclusive culture, one where people of all different types can thrive, one where critically people are less likely to fall out of the industry. Because the longer someone from an underrepresented group or a woman in technology stays in, the more success she has in her career, the greater the odds that she's going to bring people from her network, that she's going to be a mentor, that she's going to be a role model. And that's the way we're going to get lasting change. We don't have it figured out. What we have seen happen is we made some positive moves, and we've taken a really open experimental approach to the things we're willing to try to increase both diversity and inclusion. And as a result of that, we've attracted a lot of people. And success begets success.
43.5% of your workforce is female versus 30% industry average. Your numbers are way better across the board, whether it's women in technical jobs, blacks, Latinx. Facebook and Google, meantime, just released their recent diversity reports, and the numbers have barely moved. How can the rest of the industry move this in a substantial way? And what is your advice to young entrepreneurs who are starting at the beginning?
Well, so the second question is much easier, which is start it as early as possible. I guess that answers the first part of the question, too, which is once you get really big, first of all, it's hard to move things on a percentage basis. I think people have unrealistically high expectations of what kind of change we can see in the short term. But the long term, I think we will see a much bigger and more profound change than anyone realizes at this point.
That was some of my conversation with Slack CEO Stuart Butterfield. You can catch our full interview with Butterfield on Bloomberg Studio 1.0 tonight. When we come back, Greylock Partners has made big bets on everything from big data to self-driving vans. What is next? We'll talk to one of their partners coming up. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Founded in 1965, Greylock Partners is one of the country's oldest venture capital firms. It's backed the likes of Facebook, Airbnb, LinkedIn. So what are the next big trends in VC? Joseph Antonelli, partner at Greylock Partners, joins us now, and you're also the founder of Gladly, a company that you run outside of Greylock. So, I want to start with the venture capital landscape because Greylock has seen some companies go public recently, Dropbox and Zuora. How did those exits impact Greylock's appetite for multi-stage investing versus the traditional A rounds?
I mean, I think that we try to focus primarily on the early stages, but we believe in being a partner through the whole process. Mm-hmm. So I think one of the things that's unique about what we do is not only will we be the first investor, but we can help shepherd those companies through that whole process to being public and large scale.
Given the amount of capital that's flooding into this market and huge funds like SoftBank, we just saw Toyota make a $500 million investment in Uber. How is that changing your strategy?
Well, I think for the companies that we work with, in many ways, it's a really positive thing. You're seeing companies be able to get access to more capital and do more audacious, big ideas. And
that also means more competition, though, right?
I think that most of the competition that we see is the traditional venture capital folks. So those early stage investors, whether it's Sequoia or Benchmark or Andreessen, et cetera, like we tend to see those as our primary partners as well as competitors. It hasn't dramatically changed that Series A and Series B at this point, but it definitely changes the later stage.
So what are the next big trends? If social networking was one and Greylock was there, and then it was the sharing economy and Greylock was there, what is next?
Well, I mean, we focus really on two main areas, consumer investments and enterprise investments. I tend to focus more on enterprise. Mm-hmm. And we also are thinking about what I'll call sort of new opportunistic areas of investments. So obviously autonomous vehicles is a thing that everyone's talking about, and we've done some investments there.
Right, a self-driving van company called Nuro?
Right, so Nuro is a great example where what we're trying to do is take the part of the sort of delivery of goods and services that oftentimes are done by people, and how you can actually make that autonomous. So for example, if you want to order groceries, you don't have to have a person drive to your house anymore. The idea is that this vehicle will drive from the grocery store and show up at your house, and you have to walk out, you open the device, but there's no person actually even in the car. So we're going after places like that where we think that there's some really interesting vertical applications of things like self-driving vehicles.
So, talk to us about big data. Another one of your portfolio companies, Sumo Logic, competes sort of with Palantir, which has been a very controversial big data company. What is the opportunity that you see there? I mean, there's been so much data unleashed, but it hasn't been proven that it can actually be useful.
Right. I mean, I think that you highlight probably the biggest issue around data. People just collect more and more data, but data without insight it's pretty useless, right? And so Sumo Logic, the space that they focus on is around machine data. So all of these servers and computers and devices that are creating things, how do you manage those and understand what the health of those systems, how well they're performing? Basically, it's the dashboard to run the internet, if you will. So they tend to compete more with a company called Splunk, which is in the machine data space. And what they do is they basically are taking this literally terabytes and terabytes, hundreds of terabytes of data every single day, and helping companies understand what that information means in terms of how their systems are running. So whether you're Airbnb or Marriott, both are who are customers, they use it to make sure that they're understanding and managing the infrastructure that they run the digital economy on.
So talk to me about how you are, harnessing the power of big data at Gladly. And I mean, the goal is to change the customer service experience, which I think we would all agree needs to be improved.
Well, the application there is really an interesting one. One is to really understand, one example is to understand what are the questions that customers are asking of companies. So for example, JetBlue is one of our customers that we've talked about. And what we do with them is we see all the questions that customers ask, and we basically help to suggest answers first to their crew members so that they can drive better efficiency and also deliver better answers. So if you're asking questions like, what's the baggage policy question, how can we make sure that that customer is getting the right answer and also helping to drive efficiency so you get a better experience as a customer using machine learning, and you also can help them lower the cost of actually running their content.
How do you balance having machines and AI do the work versus good old-fashioned humans, especially when these are often situations where people are frustrated?
Right. So we start with the idea that we want to first make the people that are doing the help more efficient, meaning the agents. So our approach is to say, let's make the crew members that are engaging with the JetBlue's customers, how do we make them smarter to start with? Because if we can suggest an answer, if we're right 50% of the time, we've just improved their efficiency dramatically. If you're a customer and you're only right 50% of the time, you don't have a very good experience. So we're really focused first on making the person doing the support and help make them smarter, and then they're making the decision to say, oh yes, this is the right answer that I'm going to give to the customer or not.
Now, in your former life, you founded a cybersecurity company. You've testified before Congress on these matters. What are your thoughts on, continued reports about election meddling from now multiple state actors? I mean, it seems like there is no level of security which will protect us.
Clearly, at a state level, it's a challenging issue for every single country. Our country in particular, the U.S. We're obviously a target for many, many people, and it's clear that it's not just election meddling. It's the power grid. It's our utility system. It's everything that sort of powers the way we live, and it's a real risk. It's definitely a real risk, and I think one of the things that's been great to see over the last decade is actually the partnership between government and industry to work more closely together to help solve these problems. And I think the only way we're going to solve it is actually through innovation and new technology companies. Because as the threats evolve, you need to get new technologies to solve them. And I just think that it's going to be this never-ending battle, if you will, to keep up and continue to defend.
That said, you could also argue that technology and innovation created this problem. I mean, Google and Facebook and Twitter are now these massive platforms that are, potentially in a way unprotectable.
Yeah.
Is that fair? A fair analysis?
I mean, I think that it's true that, look, our society today is built on a digital foundation. Mm-hmm. That's very different than it was 50 or 100 years ago. And when you have that digital foundation, the need to protect it, both security and privacy, because there's two sides of this coin, right? As individual consumers, I care about my privacy and I want to make sure no one gets access to my data. But as a company or as a country, to be able to protect that infrastructure, the data, I mean, it is a never-ending challenge. And you're right, it is a new challenge that we face, but it's not going away anytime soon.
So you're obviously bullish on the new economy, given your focus on enterprise, your history in cyber, with companies as big as Microsoft out there, Salesforce, rising companies like Slack. We just talked to
Right.
Stuart Butterfield. Do you think there's room for new, smaller, up-and-coming players, or will they just get eaten by the bigger companies that have more resources and indefinite runway?
I'm definitely biased, so I will admit that going in. But look, I think that if you look back over the last 50 years in Greylock's history of the companies we funded, it's always been a cycle where there's new companies, new incumbents that do things differently and ultimately become those big companies. I mean, Salesforce was only started about 20 years ago. I mean, they were a startup just across the street, and look at them today. And we see that trend continuing. We actually don't see that changing. It doesn't mean that every company becomes a Workday or a LinkedIn, but we know that there will be some that do.
All right, Joseph Antonelli, partner at Greylock, also running Gladly. Thank you so much for stopping by. Great to have you back. Well, Square shares climbed in Wednesday's trading after Guggenheim added it to its best ideas list and gave it the highest price target on the street at $100 a share. The revenue potential from the firm's Cash App is underappreciated, analyst Jeff Cantwell said in a note after meeting with Square CFO Sarah Friar. Coming up, one analyst out with the most bullish call on the street for Amazon and Alphabet, why optimism for tech is still swaying the markets. Next, this is Bloomberg. U.S. stocks plowed to new records Wednesday, with tech shares helping to lead the way. Meantime, Brian Nowak with Morgan Stanley is striking a bullish tone for Alphabet and Amazon, while the latter is hovering at new all-time highs. Romain Bostic, Bloomberg TV's markets editor, joins us now from New York with more. So, Romain, talk to us about this note from Morgan Stanley.
Yeah, I mean, he's basically making a very bullish call, and frankly, he's not really alone on this. Quite a few analysts on Wall Street have taken a much more bullish view, if that's even possible, of a lot of these big tech names, and a lot of it really has to do with their market dominance and what a lot of these analysts perceive as their continued dominance. When they look at names like Amazon, they look at Alphabet. A lot of what they're looking at is what type of competition do these companies really have now? What type of competition are they really going to have a couple of years down the road? And they're also looking at the general market picture, the idea that there are still a lot of consumers that haven't really embraced these particular companies or these particular platforms, and that once those consumers sort of become a little bit more integrated into those products and services, that will benefit these companies even more.
Amazon shares have doubled over the last 12 months, though. Are expectations too high?
Well, I mean, it's funny, you think about, this stock, has doubled, as you said. I was looking at the price targets for Amazon. I mean, you had at the start of the year a price target that was somewhere just below $1,300 a share. The price target going forward now is at about almost $2,200 a share. I looked at the data, and here's the thing you have to think about, Emily. A lot of people are basing these price targets on the revenue growth. And when you look at annualized revenue growth for Amazon over the past, if you just take the beginning of the bull market back in 2009, it's running at somewhere in the neighborhood of about 40% or so. So when you think about, the share price is running annualized of about 40% or so, but the revenue growth is running at an annualized pace of around 30% or so. So the revenue growth is really kind of keeping pace with a lot of the optimism that you have in the shares. So, if you break it down over a longer term trend, it's not as outrageous as I think it looks when you look at it maybe on just say a 1 year chart or a 6 or 7 month year chart. There is a lot of reason why analysts remain bullish, and it is that revenue growth.
Meantime, Bloomberg is reporting there's still a lot of short bets out there on the FANG stocks. Where are the shorts concentrating their focus?
Well, you've got sort of two sides to this coin. You have some of the shorts obviously going into some of the names that have seen troubles, like Tesla, like Alibaba, like Facebook. But of course, they're also piling into Amazon and Apple. And a lot of that has to do with valuation. Look, when you're talking about Apple at $1 trillion, when you're talking about Amazon just a breath away from being a $1 trillion market cap, it's understandable that you're going to get an increase in short positioning as well. That's just sort of normal. normal, and I think it sort of goes with the flow. But when you look at sort of the ratio, like the short interest ratio to some of these companies and the growth over the course of the year, it's really not as dramatic. In fact, for some of these companies, the short interest ratio has actually fallen. Even for companies like Google, for Alphabet, where it has risen, it's risen, something like less than 1% from where it was at the start of the year. So people are being a little bit more cautious, but again, you still have this sort of fear of missing out. Do you really want to be that investor, that fund manager who jumped off the boat just as it was really getting to take another leg up?
All right, Romaine Bostick, Bloomberg TV's markets editor. Thank you so much, as always, for stopping by. Meantime, Amazon and Whole Foods have expanded delivery of grocery through Prime Now in new cities across the United States, including Columbus, Dayton, Portland, Greater Washington, D.C., and additional areas of New York City. As Amazon pours more money into its Whole Foods venture, competitors like Walmart, Kroger, and Target have also stepped up their online grocery presence. Much more coming up, and a reminder, Bloomberg Tech is live streaming on Twitter. You can check us out at Technology, and be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg. Salesforce earnings are just out after the bell, and this is the latest tech company to embrace the idea of having two chief executives. The San Francisco-based software maker has recently promoted Keith Block to run the company alongside co-founder Mark Benioff. Block started with Salesforce in 2013, became chief operating officer in 2016, and also serves as vice chair. Earlier, I sat down for an exclusive conversation with Block and asked about his experience as co-CEO so far, as well as the latest results.
We're certainly in a situation where Mark and I have been working together very, very closely. We've been together for over 5 years. We've known each other a long time. And this is just a natural extension of the operating model that we've been working together. So when you think about our company, we're a large global enterprise. We're growing quickly. And this is an opportunity for us to put together a decision-making process that enables us to make decisions very quickly for our customers. And again, it's just a natural extension of what we've been doing.
So he's a co-founder of the company. He's a big personality. How do you divide responsibilities?
Well, again, we've been operating under these principles for the last 5 years. It's a very trust-based relationship. It gives us an opportunity to focus on our strengths. Mark, when you think about Mark as you described him, he's a visionary. He has great ideas around the product strategy. He's an outstanding CEO. He's passionate about the culture. My focus is on growth and execution and customer success and operational excellence, and it really allows us to focus on our strengths and areas of expertise.
So look, co-CEO structures haven't necessarily worked out so well. In other cases, in fact, some would say it's prevented the ability to be decisive. How do you overcome those historical precedents? Like, what are the plans to troubleshoot if necessary?
Well, again, I think it starts with trust, and we have a very, very trust-based relationship. We're both trusted advisors to each other. We collaborate all the time. We make decisions together. We see this as a way to execute at speed, at scale, because we're growing at scale. Look at our results in Q2. You've seen our results in Q2. We're wildly excited about what we've done in Q2. And this is just a great operating model for us.
So you've boosted your forecast for the year. The stock is down slightly after hours. What should investors be looking at in this quarter?
Well, I think the investors should be thrilled because we are thrilled with these results. Again, we're the #1 leader in the #1 category of enterprise software, the fastest growing category of enterprise software. We're #1 in sales and marketing and service and platform. And we're growing at a rate that is twice the rate of the market. So we're taking share, we're driving success with our customers, and we're very, very pleased. We're operating at scale, we're growing at scale, and everything is going well with the company. We're very pleased with the performance.
You said you're well on your way to that $23 billion in 2022. What do you need to do to get there? What will you do to get there?
Well, I think that growth strategy is in place. When we think about our growth levers, we think about our international expansion. Our fastest growing region was in EMEA this year at 32% growth, so we're super excited about that. APAC was at 28% growth. We think about our focus on industries and speaking the language of our customers, so we're doing some incredible things in financial services, in manufacturing, and public sector. And then, of course, we have the world's largest ecosystem in the cloud. We have great business with our systems integrators and our ISVs. So we're very, very thrilled with that growth strategy. And again, we're operating at scale, we're executing at scale, and we're on our path to the $23 billion goal, which makes us the fastest growing top 5 enterprise software company in the world.
Salesforce has redefined customer relationship management. What are the white spaces you see out there that still exist for you?
Well, there's plenty of opportunity just in the space that we play, but as you know, we're considered to be one of the most innovative companies in the world. So again, having the market share leader in sales and service and marketing and platform, there's a lot of room to run. Focus on our industry specialization and our industry strategy and our industry solutions, focus on our international expansion. All of that just realizes great customer success and great growth, like our success in the quarter.
Salesforce has been known for making big deals. We've seen you make some fairly big acquisitions of late. How much will M&A be part of your strategy, and where?
Well, you know, it's very interesting. When we think about our growth strategy, we think about both organic and inorganic, and our ideas always come from our customers. We listen to our customers. They give us our great ideas. When we acquired MuleSoft, our most recent acquisition, just in Q2, as you know, we've seen great success with this already, but we got that idea from our customers. When we bought Demandware, we got that idea from our customers. So we listen to our customers to drive our innovation strategy and our growth strategy.
I've traced plenty of Salesforce acquisition rumors. Often we hear Twitter come up, that Salesforce is interested in buying a company as big as Twitter. Is that something that has ever been of interest? Well,
again, we listen to our customers, and that's really a guiding light. They are an inspiration for us, and that's how we decide how we innovate, whether it's organically or inorganically.
So let me put it this way. Would you do a deal that big? Are you open to big, you know, potentially transformative but also risky deals?
Well, again, MuleSoft was the largest acquisition that we've done in the history of the company, and it's just been, you know, barely 90 days, and we're super excited about what we're seeing.
So let's talk a little bit about international expansion. You said we should look for growth there. What is the actual status? Because that's where Salesforce has a lot of untapped opportunity.
Well, we've made a lot of investment over the last 5 years to drive growth in the international space. Again, EMEA was 32% growth in the quarter. APAC was 28% growth in the quarter. And really, this is a strategy born out of driving success for our customers globally. We want to be able to service our customers globally. So there's a lot of room to run. And we're very, very excited about those results. You can see it in our Q2.
You worked at Oracle for 26 years. We've heard Mark Benioff and Larry Ellison trade barbs many, many times. Is Oracle in as dire straits as Benioff seems to think it is?
Well, look, we're in a wonderful place. You know, that was a planet a long, long time ago, long, far away ago. I've been with Salesforce 5 years. I just celebrated my 5th year anniversary in June. And I couldn't be more thrilled to be here, working with Mark, leading the company in the future together with Mark, and excited for the future for Salesforce.
So who is the competition then?
Well, there's competition in every element. And you know, in any given time, there's a different type of innovation that could enter our space. Our category of CRM continues to broaden. So we see competition, but the fact of the matter is that look at our results. We're the category leader in CRM, the fastest growing segment of enterprise software. We're growing at twice the rate of the market. We're taking share. We're operating at scale. We're growing at scale. We're executing at scale. And at the end of the day, our job is to focus on our customers. We have over 30,000 employees. They wake up every single day, and their focus is on driving customer success. And if we take care of that, everything else will take care of itself.
So as the company continues to sort of verticalize its sales strategy, what are the industry sectors that we will see you target?
Well, certainly financial services has been a hotbed for us. Healthcare is also a hotbed for us. Public sector, manufacturing, telecommunications, kind of the classic that you would expect. And we can see just huge opportunity to drive success with our customers there.
Dreamforce coming up?
Very exciting.
What should we be looking forward to?
Well, we know that you're going to be speaking, so we're looking forward to that. Look, Dreamforce is our big event of the year. We have over 175,000 people who will be attending, millions of viewers online. It is a celebration of innovation. It's a celebration of success for our customers. It's going to be at the end of September, and it's always a great event.
So, you know, obviously the cloud is growing, but yet it's a war. It's a war between Amazon and Microsoft and Google and potentially Salesforce, depending on how you look at it. Do you have any concern that those big companies will make it impossible for a company like you to ever get there?
Well, we like to think of ourselves as a big company. Again, we're the #1 category leader. We'll be $23 billion at the end of FY22. But, you know, these are our partners. We have partnerships with Amazon. We have partnerships with Google. We have partnerships with IBM and Dell. And we have partnerships with Microsoft. So
it's always difficult, though, with Salesforce and some of these other companies like Dell to draw that line between frenemy or enemy.
Well, it's really cooperation. But this is not unique to the cloud. This has been around forever. And, you know, as long as you have a transparent relationship and you work collaboratively with these partners, it all works out for the customers.
Our exclusive conversation with Salesforce co-CEO Keith Block and That does it for this edition of Bloomberg Technology. Tomorrow, we will catch up with Keith Raboy, partner at Khosla Ventures, on his latest investment into residential real estate platform, Bungalow. I'm Emily Chang in San Francisco. This is Bloomberg.